Thanks, Karen and Ian, and good morning, everybody. Pleased to be able to be here to present the report today, and even more pleased that it was actually tabled this morning so I can tell you about it and let you out of the room afterwards. Pulling this report together has really been a big effort within our office, and Ian's spoken about that. I think it really is a rich summary of issues and insights that we put together, or you can only really put together if you're the auditor of all 140 councils in the sector. There's also some issues from our 15-16 audits, and we did a few of those audits because councils asked us to do, or they didn't have an auditor appointed. So the report itself contains 5 chapters. There's a chapter on financial reporting, one on financial performance and sustainability, one on asset management, one on governance and internal controls, and the final chapter on information technology. I'm going to take you through the first 4 chapters over the next half an hour or so, and then there'll be a good solid half an hour left over for comments, questions, discussion in the room. And then after the break, my colleague Alan, who's an IT audit specialist, is going to go through the IT chapter, so that'll be after the break. Ian mentioned the data visualisation. When you have a chance to go to our website, you'll see the report, the visualisation and the YouTube video. They should all be up there this morning. I know that the report and these presentation slides have been loaded up on the website. You've got the executive summary in your packs of the report. Just on the visualisation, it's really a way to present the data in our report in a more accessible way. It doesn't, by itself, indicate whether a council's performance is good or bad. It's just data, and it could help you compare and ask better questions when you're interacting with the council. So I hope you find those innovative tools interesting. Before I go through our findings, I just wanted to give you some context for the report. When you go through the report, and it is quite a dense report with a lot of issues in it, you'll find that I think it's very evidence-based. We've only reported what we found in the audits and what we reported to councils. All of our audit reports go to Audit and Risk Committee chairs, so in terms of your own councils, there shouldn't be any surprises in there. The other thing to note is our audits test on a sample basis. So whilst a particular issue may not have been reported through our audit reports to your council, you should consider whether the issues in our report are applicable to you anyway. Because I think that our feeling is that a lot of the common issues may be more widespread than what we've picked up and reported on through the first year audits. And I think it's important as audit committees that you not only track management's progress in addressing specific issues that we've raised in our management letters, but you also consider the common issues in our report and question management on whether those things are relevant. We do acknowledge that every council is different and needs to be different, and there's no one-size-fits-all approach when it comes to addressing some of the risks and issues we've reported. So it's going to be appropriate for councils to have different approaches to address the risk, and that's absolutely as we would expect. At the start of the report, we just give a small overview on councils, and when you look at council spending by function, that's where it becomes very apparent that councils are different. You know, there are some functions like waste collection that might be similar or look similar across councils, but the types of services that councils do provide to their communities does vary greatly. And that mix is influenced by things like the needs of the local economy, the types of assets that those councils manage, population density, demographics, and the local economy, geography, and climate. So these factors do need to be considered when comparing councils, both financial information and performance information. So getting into the financial reporting chapter, as Ian mentioned, we did issue 136 unqualified or clean or unmodified audit opinions on the 2016-17 financial statements. But in getting there, the number of prior period errors and significant matters that we came across and reported, I feel are strong indicators that overall, it's fair to say the quality of financial reporting can improve. Today I'm going to talk a lot about issues in relation to assets, how assets are managed, accounted for and valued. So asset valuation issues were the reasons for 2 qualified audit opinions and probably the majority of the significant matters that we came across. So what were the reasons for the modified audit opinions? Well, in one case, the methodology used by a council to value land under roads and community land assets did not take into account the external restrictions on the use of this land, which is required by Australian accounting standards. Now, I'll go back into that a little bit more when I talk about asset management. Another council didn't demonstrate that infrastructure assets were reported at fair value because it didn't undertake a valuation, a 5-yearly valuation that it was supposed to do. So it couldn't be determined if the assets were still at fair value or not. Another council didn't record financial assistance grants in the year that they were received, also as required by Australian accounting standards, and I'll talk about that as well a little bit more later. We also issued 2 disclaimers of opinion in relation to the 2015 financial statements of a council and 1 water authority. The first one was due to significant breakdowns in administrative, financial and governance controls, which affected the reliability of the financial reports, and also a significant fraud was identified at that council. In terms of the water authority, management were unable to confirm that all transactions in the financial statements had been recorded due to control weaknesses in the finance system. So both of those councils had a disclaimer of opinion. Another council, while we didn't qualify the audit report, we did include an emphasis of matter, and that was in relation to uncertainty about whether the council could continue operating without dipping into restricted water and sewer funds for the use for general operations. This council did not have ministerial approval to use those funds. Ian mentioned prior period errors. The prior period errors are those that we find in the current year that relate to the previous year's audited financial statements. Accounting standards require that if they're material, they have to be adjusted retrospectively. We found 33 material prior period errors across 22 councils. The value of these errors was over $9 billion. 88% of these related to assets, including the failure to consider restrictions on land, and also others related to assets that were not captured in the financial statements, or in other cases, assets that were in the financial statements and shouldn't be there. Some errors also related to the way councils recorded or accounted for grants, which should have been recorded as revenue. Significant matters. The auditing standards require that we report significant matters that come up during the audit to those responsible for governance. So we consider that to be the mayor or the administrator, the councillors and the general manager. But we also report significant matters to the audit committee because we understand that you've got a key role in overseeing risk and the financial reporting process. Significant matters that we report can be material accounting issues, but also internal control weaknesses. And like for prior period errors, many of the significant matters that we found related to asset valuation and revenue recognition, but they also related to other areas. Some related to internal control deficiencies over IT governance and security, and we'll touch on those after the break. And we also found the inappropriate use of corporate credit cards, as well as restricted funds, which I've already mentioned. In terms of other quality indicators or issues that we identified, in many cases, incomplete financial statements were submitted for audit. So in our management letters to 43 councils, we reported moderate risk findings in relation to the financial statements preparation process. That's about a third of councils. So I think a greater focus on quality assurance processes around the preparation of the financial statements would reduce the number of errors and disclosure deficiencies that we find. We have referenced in our report some better practice guidance for preparing financial reports, which we hope you find useful. In terms of audit committees, you know the councils at the moment are not required to have an audit committee, and I will talk about that a little bit more later. But of the 85 councils that do have a committee, only 45% of them reviewed the financial statements before they were submitted to audit. So there are many things that we believe the audit committee can do to support quality financial reporting. For example, the audit committee can ensure key risk areas like asset valuations have been addressed. They can track findings, audit findings from previous years, to make sure that they've been satisfactorily resolved by management. They can ask management to provide them with key estimates and judgments in the financial statements and assess whether they're reasonable. And they should be recommending as well to council whether the financial statements are in order to be signed. So to improve the processes around preparing financial statements though, councils do need to have the tools and guidance available that they need on a timely basis. And that hasn't been the case in the past. So in our report, we've recommended that OLG actually release the Code of Accounting Practice and Financial Reporting and the end-of-year financial circular and other guidance much earlier than what they've done in the past. And we've also recommended that guidance does align with Australian accounting standards so that there are no inconsistencies. And I think that OLG have heard these recommendations because the Financial Reporting Code was released on Wednesday. In terms of timeliness, so as you know, the statutory deadline for councils to lodge their accounts with OLG is 31 October. 100 councils met this requirement last year. Of these, 71 submitted their audited accounts in the last week of October. The other 40 councils applied for and received a lodgement extension. This included 16 of the newly amalgamated councils who reported challenges in harmonising accounting policies and practices and in combining separate and distinct information technology and reporting systems. Other reasons put forward by councils for that requested extensions were resourcing issues and the lack of financial records, particularly asset records. In addition to that, many councils provided multiple versions of their financial statements during the audit. In one case, one council provided us with 15 different versions of the financial statements. So all of this had implications on audit resourcing and flow-on implications on the timely completion of some of the audits. So, early close. In our report, we have mentioned early close procedures, and these are procedures that are done before the end of the year to identify and resolve key risk areas. They can really improve the quality and timeliness of financial reporting, and they have definitely done that in the state government sector. We've recommended that OLG consider introducing the requirement for early close procedures, but with an emphasis early on asset valuations, because getting on top of the asset valuations early before the end of the year will improve financial reporting. That would be the number one thing to do. So what we're recommending the councils do is engage with their auditors and external valuers early in the financial year. Ensure the results of valuations are reviewed for quality and critically assessed. And try to have the valuation completed and booked at a month end before 30 June. The councils that are signing their financial statements early are doing that. That's how they do it. And I think the Audit Committee can play a key role in supporting early close initiatives and assessing any findings that come from that work.
Are you writing individually to all the councils suggesting they do that?
We have included in every council's client service plan this year a section on early close to have a conversation about what might be done to improve on last year. So the next chapter I want to touch on is our chapter on performance and sustainability. So as you would know, councils report against 6 performance measures in their audited financial statements. These are performance measures that are prescribed by the Office of Local Government. There are 2 operating performance measures and 4 liquidity and working capital measures. In 2016, most councils met the benchmarks, the OLG benchmarks, for 5 or 6 of these audited performance measures. But some councils only met 3 or 4 of the measures. These indicators only provide a snapshot at a point in time and do not in themselves allow judgments to be made about good or bad performance. In addition to those audited indicators, you'd be aware that councils report performance against 4 asset measures in Special Schedule 7, report on infrastructure assets. This schedule is not part of the audited financial statements and it's not audited. In terms of the 2 operating performance measures, these are used to assess how well councils are keeping operating expenses within operating revenue. So achieving the benchmark means that councils are raising enough operating revenue to fund operating expenses. 18 councils reported negative operating performance in 16-17, and 5 of these councils have reported negative operating performance for the past 3 years. The receipt of the 2017-18 financial assistance grants in June last year did help the operating performance of councils. Without these grant payments, another 20 councils would not have met OLG's benchmark for operating performance. I mentioned earlier that 1 council did not record the receipt of these grants as revenue, and that resulted in a qualified audit opinion. In our audit report for that council, we did note the impact on the indicators, and that had they recorded those grants, they would have met the operating performance benchmark. The second measure for operating performance is own source revenue, and this assesses the degree to which council can generate its own source revenue compared to revenue from all sources. OLG sets a benchmark for this at 60%. This measure is sensitive to revenue from capital grants and developer contributions, and the percentage will fall if revenue from these sources is significant. 59 councils did not meet OLG's benchmark, and 42 of these councils were rural councils. So this can indicate insufficient revenue to cover expenses, or possibly an over-reliance on grants. But in terms of rural councils, they do face challenges in generating own source revenue due to the smaller populations, the lower land values, and less economic activity overall. The revenue and expenses of councils, they do vary significantly as well, council by council and cohort by cohort. Councils in metro areas have the greatest capacity to generate other revenue streams, such as from childcare, parking fees, rental income, and infringement notices. Rural councils rely more on grant funding to deliver their services. County councils don't receive rates, but they do levy charges and fees. And in 16-17, 40 councils received revenue from special rate variations that were approved by IPART. These variations range from 2.8% to 10.8%, but in one case, 1 rural council levied a special rate of 30%. On the expense side, employee benefits is generally the largest expense category for most councils, followed by materials and contracts expenses and depreciation. In respect of depreciation, regional, rural and county councils have larger proportion of depreciation expense compared to metro councils because they generally have extensive infrastructure asset bases over large areas. This includes infrastructure for water supply and sewerage, which state agencies provide in metropolitan areas. Looking at the liquidity and working capital, the rates and annual charges outstanding percentage assesses how successful councils are in collecting rates and charges. OLG sets the benchmark for unpaid rates and charges at less than 5% for metropolitan councils and less than 10% for other councils. 18 councils did not meet OLG's benchmark and may, as a result, have less working capital available to fund operations. One council reported a rates and annual charges outstanding percentage of 36%. The cash expense cover ratio estimates the number of months a council can continue paying its expenses without extra cash inflow. OLG sets a benchmark of greater than 3 months for this ratio, and all but 3 councils met this benchmark. In fact, 63 councils had enough cash on hand to fund more than 12 months of expenditure. However, councils are not required to exclude externally and internally restricted funds when they calculate the cash expense cover ratio. So if you were to exclude restricted funds and recalculate the ratio, all councils would still meet OLG's benchmark. But if you were to exclude internally and externally restricted funds and recalculate that ratio, 8 councils would be left without any funds for operations, and 32 councils would not have a cash expense cover ratio of 3 months. OLG sets a benchmark for councils to have unrestricted current assets more than 1.5 times the value of unrestricted current liabilities. All but 3 councils met this benchmark for the unrestricted current ratio. This indicates that they can meet short-term obligations as they fall due. In fact, we found 96 councils had twice the OLG benchmark for working capital. OLG also sets a benchmark for councils to have more than twice the amount needed to service debt. 126 councils reported borrowings at 30 June 2017, primarily used to fund capital projects and address backlog maintenance. Regional councils accounted for 56% of the value of total council borrowings, because they also borrow to manage water and sewer infrastructure. Only 2 councils did not meet OLG's benchmark for the debt service cover ratio. And in fact, this was only because these 2 councils repaid significant debt during the year. In terms of the asset management, Special Schedule 7 provides information in addition to that available in the audited financial statements. This information, which is unaudited, relates to the maintenance, renewal, condition and costs of infrastructure assets. When we look at the overall picture for these 4 measures, it suggests that councils may need to review their asset management plans and consider if spending on infrastructure is sufficient to maintain service delivery. 70 councils do not meet OLG's benchmark for the building and infrastructure renewals ratio. This measure is used to assess the rate at which infrastructure assets are being renewed against the rate they're depreciating. OLG sets a benchmark of 100%. And also, OLG's recently informed the Audit Office that most councils have included work in progress assets when they've calculated this ratio, and they're of the view that that's not correct. And recalculating the ratio excluding work in progress, a further 23 councils wouldn't meet the benchmark, or 93 councils altogether. The infrastructure backlog ratio shows the amount of infrastructure backlog expenditure relative to the total net book value of a council's infrastructure assets. OLG sets a benchmark for this ratio at less than 2%. Achievement of that benchmark could indicate that infrastructure backlog is at a manageable level. 70 councils do not meet the benchmark for infrastructure backlog. The third measure, the asset management ratio, compares the council's actual asset maintenance expenditure to the amount that they said they were going to spend in their asset management plan. OLG sets a benchmark of greater than 100%. So achievement of that benchmark would indicate that, possibly, that a council is investing enough funds to sustain their assets in a functional state, and so that they can reach the end of their predicted useful life. 71 councils do not meet OLG's asset maintenance benchmark. With respect to the final measure, which is the cost to bring assets to an agreed service level, OLG has not prescribed a benchmark. The next chapter of our report on asset management, and this slide I think demonstrates the range and value of assets under the care and control of councils. Council water and sewer assets are more than twice the value managed by Sydney Water. The extent of council land and buildings is similar to the portfolio managed by the state government's Land and Housing Corporation. Councils manage a roads portfolio that's about 70% of the value of the state's roads, which are managed by Roads and Maritime Services. So managing long-lived infrastructure assets is definitely a core responsibility of councils. Our financial audits, however, primarily focus on the aspects of asset management that impact on the annual financial statements. So as you'll appreciate, the risk factors in this key area are much wider than what we would report on. So what did we find? We reported 10 high risk and 153 moderate risk findings in our audit management letters on assets. We found many issues relating to asset registers. Some of the things we found: manual spreadsheets used to store data without any controls to protect their integrity. Multiple fixed asset registers with inconsistent content and formats. Inaccurate and incomplete asset registers without supporting documentation. Asset registers that do not or are not reconciled with asset management systems used for operations. Completed works in progress that's not capitalised on a timely basis. So, besides the obvious financial reporting implications of these issues, I think it also would affect the council's ability to maintain and manage its assets effectively when these asset registers are incomplete and inaccurate. Asset valuations is another area where we reported high-risk findings. Valuing large infrastructure assets is a complex process that needs to be well planned, managed and documented. I've already mentioned asset valuations, that early valuations leave more time for management and audit committees to critically review the outcomes. We identified that 10 councils had overstated community land and land under roads, as their valuation did not reflect the physical and legislative restrictions on these assets. Most council community land is subject to legislative zoning restrictions through a local environmental plan. Land under public roads is subject to physical and legislative restrictions under the Roads Act. Councils can't lift these restrictions on their own, not without the approval of external bodies. 9 councils agreed to correct the asset values in their financial statements to reflect these restrictions, but one, as I've mentioned, had a qualified opinion. Other valuation issues we identified in some councils there were no policies or procedures to support the asset valuation process. The valuation scope and method was not agreed with the external valuer before the valuation was completed. Valuers were provided with inaccurate records, incomplete asset registers, resulting in assets being excluded. Management did not review the valuation results in some cases, and cases where the evaluation process was so late that the asset register and general ledger couldn't be updated before the financial statements were prepared. So I've already mentioned the role that an audit committee can play in supporting and challenging management through the valuation process. A key element of OLG's integrated planning and reporting framework is a requirement for all councils to have an asset management strategy, policy and plan. We found 13 councils don't have these documents in place. And I do point out that newly amalgamated councils, which are not included in that 13, have until 30 June this year to have those plans in place. In terms of asset useful lives, We reviewed the range of useful lives that councils reported in their financial statements. We found considerable variability in the way councils reported the useful lives of similar road assets. So I think some variability in useful lives would be expected due to different soil types, methods of construction, geography and environment. However, these differences do not fully explain the large variations we've observed. I think this variability does impact the depreciation expense calculated by councils for similar assets, and therefore the key sustainability indicators that are reported. We found that some councils are not reviewing the useful lives of assets annually as required by accounting standards. And we also identified instances where useful lives were not adjusted to take into account physical condition assessments that were available. We also report on $145 million of previously unrecorded assets. So these covered most classes of assets and were identified through a number of means: during asset valuations, when reconciling asset registers with operational management systems, and during asset count processes to support the amalgamation of councils. In addition to these unrecorded assets, we also identified that a significant portion of rural firefighting equipment is not reported. 46 councils recorded rural firefighting equipment, which is vested to them under the Rural Fires Act, in their financial statements. However, 62 councils did not record these assets. Consequently, they're not reported in the financial statements of any state or local government. We've recommended that OLG work with New South Wales Treasury to address these differences in accounting practices before 30 June this year. Moving on to governance and controls, which is the final chapter I'll talk on before questions. We reported 36 high risk, 710 moderate risk governance and internal control issues. I think Ian mentioned that we reported more than 1,000 issues overall. So many of these issues were in the information technology area, and we'll go through this later after the break. I've already discussed, I think, the issues we found relating to assets, so let's have a look at some of these other areas that we reported on. In 16-17, councils collectively spent $3.5 billion to acquire property, plant and equipment, and $3.9 billion on supplies, services and general expenditure. So I think you'll agree the procurement function is clearly a key area of focus and risk for councils, and it's also the case for our audits. So what did we find? Well, in some councils we found instances of purchase orders being raised after the goods or services were received and paid for, unauthorised expenditure or expenditure approved by an officer without the necessary delegation, inadequate segregation of duties between the purchasing and payment functions, reports that were designed to detect irregular or unusual charges and changes that were not reviewed, and in some cases non-compliance with the tendering guidelines for New South Wales local government. In the payroll function, the high-risk issue that we identified involved a council where payroll staff had unrestricted access to amend sensitive payroll data in the system, and there were no mitigating controls in place to reduce the risk. Other findings in the payroll area included where there was no review undertaken of changes to details in payroll master files. There were unapproved staff timesheets and leave forms, and payroll exception reports and termination payments that were not reviewed. In terms of the financial accounting issues, they generally related to two areas: manual journals, which are those which are used to adjust council's financial records, and reconciliation processes, which are those that support the preparation of accurate financial statements. In one case, we found that journals could be posted without any review by a second officer, even though fraud had been committed at this council in this area in the past. In terms of reconciliations, if they're not prepared and reviewed promptly, it does impact on management's ability to identify and resolve issues, and this can lead to errors in the financial reporting. Audit committees. So as you know, councils are not currently required to have an audit and risk and improvement committee, but obviously many do. 53 councils, though, don't have an audit committee, and 52 councils do not have an internal audit function. So as you'll appreciate, these functions are really important elements of an effective governance structure. A governance structure that supports a risk and compliance culture. You would be aware that changes in the Local Government Amendment, Governance and Planning Act, will require councils to establish a committee by March 2021. Now, OLG have confirmed that this requirement will not be any earlier than that date, because the regulations say that it can't be before 6 months after the next general election. We've recommended that councils early adopt the requirement to have an audit committee, and I understand that some chairs from newly formed committees are here today, so that's great. OLG tell me, most recently, this week, that they plan to release guidance on audit committees and internal audit for consultation by 30 June this year. While we wait for that guidance, I think there are plenty of better practice documents that are available and may be useful to get a head start on that area. New South Wales Treasury publishes policies on risk management, internal audit and audit committees, which include model charters and other useful tools. And the OLG equivalent in other states also publish information that can be useful. What about other governance matters? Well, we reported 73 instances across 47 councils where policies and procedures didn't exist or had not been updated in critical business processes such as financial management, information technology, procurement, and contract management. We found that 45 councils do not currently have a legislative compliance framework, which would include a compliance policy and a compliance register. So without these, there is an increased risk that councils may breach legislative requirements, attracting penalties, or suffer disruption to service delivery and even reputational damage. So I would expect that there are opportunities to share compliance registers, for example, and between councils, and for smaller councils to leverage off larger and better resourced councils. In terms of risk management, while our financial audits are not designed to assess every aspect of risk management, we did identify 20 instances in 17 councils where risk management practices could be strengthened. The issues we found related to the lack of or outdated risk management frameworks, risk registers and/or risk policies and procedures. And finally, we also found uncertainty in the legislative framework governing the oversight of council entities and their financial reporting and auditing requirements. So council entities, these are entities that councils establish, which in many cases require the approval of the minister. So we reported that the current uncertainty in the legislative framework can result in a lack of transparency and accountability over the activities of these entities. And we've recommended that OLG maintain an accurate register of council entities and consider establishing a financial reporting framework for them. Okay, so thanks for listening to that, and happy to open up for questions, comments. It'd be great to have a conversation between yourselves. Any reflections on anything I've said or any other matters?